Hi, friends. We're here to help you with your home loan questions and answers that many of my clients are asking, especially with the higher interest rates. But welcome and allow me to introduce my special guest, Andrew Snyder with NFM Lending. He's an excellent mortgage loan originator here in Georgia. Thank you for joining us today, Andrew.
Thank you so much for having me, Karla. I really appreciate it. I know you're a big YouTube star, so it's an absolute honor to be on your channel. Um,
Aw.
just a little bit about myself so that you can kind of put a face to the name. So I've been a mortgage lender for over 7 years now. I work for a mortgage company called NFM Lending, and I would say my favorite part about being a mortgage lender is really just being able to sit down with clients, or these
Mhm.
days over the phone with clients, and put together strategies that make the most financial sense for them. And I just find that very rewarding.
It is. It is. That's why I got in real estate myself. I love helping people, and it truly is rewarding when you go through the whole process. So that's awesome. So when you're not helping clients, is there anything you enjoy doing in your
There
spare
are
time?
a couple of other things that I do enjoy doing. One of my favorite things to do is actually run. So I'm a big marathon runner, which
Awesome.
may be a personality flaw. I'm still trying to figure that out, but I do enjoy running.
Awesome. That's impressive. I don't think I could ever do a marathon, but I'm impressed. And that keeps you nice and fit too.
Try to.
Awesome. If you guys have any questions after watching or would like to chat with either one of us, you can find our contact info in the description down below of this video. So today we've got 6 ways to help you get the best mortgage rate because there's different options out there to help you. So first up, we have number 1, what are some buy down options for buyers?
Yeah, that's a great question. So there's two different types of seller buy down options that a buyer could take advantage of. So basically what a seller buy down program is when the sellers pay a certain portion of closing costs to help the buyer decrease their interest rate and their
Mhm.
monthly payment in turn. So the two different options are the 3-2-1 buy down, and then there's
Mhm.
also the 2-1 buy down option.
Hmm.
So essentially what that means is the 3-2-1 buy down is when your mortgage payment is reflective of an interest rate that's 3% lower than the market rate for the first year,
Mhm.
2% lower than the market rate for the second year, 1% lower for the third year, and then years 4 through 30, the interest rate goes back to whatever that market rate is. So, for example, if the interest rate is currently 6.5%, that first year you would only be paying 3.5%.
Wow.
So it's a really good option to find affordability in an
Mhm.
environment where the interest rates are higher than what they have been in the past couple of years. And
Right.
also a great option, especially knowing that a lot of economists are pointing towards interest rates dropping within the
Mhm.
next year or two. So what this allows you to do is have a lower payment upfront, and then
Mhm.
as we start to see interest rates drop, you can refinance into a fixed rate so that
Mhm.
your payment is locked in throughout the life of the loan. Now, with these options, I always do encourage people to make sure that they're still comfortable with what
Right.
that market rate is. The last thing that we want to see is a buyer get
Mhm.
into a payment that they're really comfortable with those first 2 years, but then once it goes back to the market rate, they're really going to have to stretch. So I would say,
Right.
these are great options. Just make sure that we're looking at the worst case scenario and that we're comfortable with the worst case scenario as well.
Right. Well, and in our competitive market, because we're at only 2 months supply or less in some instances of inventory, which is our keeping our prices steady, it's a good option to kind of buffer yourself and protect yourself from inflation because you have the potential home appreciation in the meantime. Um,
Absolutely.
so that's a substantial, savings. So if it's an option, because it is seller paid. So that's a key point there. Awesome. And you mentioned there was 2 options. So what about with an FHA loan?
So on an FHA, a conventional or VA loan, you also have the option of doing a 2-1 buy down.
Okay.
So the 2-1 buy down is relatively self-explanatory. So 2% lower year one than the market rate, 1% lower year two, and then years 3 through 30, it goes back to the market rate. So I'm sure
Right.
you're asking, why would I do the 2-1 buy down instead of the 3-2-1 buy down? Basically, it costs the sellers more money to pay for the
Okay.
3-2-1 buy down than the 2-1 buy down. So I always suggest, if you're interested in these options and we feel like it's feasible, every time you're going to look at a house, let me know the address of the house, what you plan to
Mhm.
put an offer in for, and I can tell you exactly how much the sellers are going to have to pay to make either of these two options work.
Right. And there's so many sellers are getting the pricing wrong that there's some opportunity there. I always tell
Absolutely.
my clients, because some of them are being, with that higher interest rate and the cost of the housing or having to go over, we go in the MLS and I'm looking for the ones that are sitting. Because right now in our local Alpharetta market in North Atlanta, if a home isn't priced according to the market, it's not selling in 10 days.
Right.
It's taken 30 days and they're having to do multiple price reductions. So that's an opportunity for a buyer. So,
Yeah. Yeah, I'm
yeah,
absolutely seeing sellers pay costs right now. It's never a guarantee that it's going to happen, but there are definitely a good amount of instances where sellers are paying costs, and these options are available in today's market.
right. So, I mean, compared to a year ago, I mean, that was
Yeah.
out the window and not even, having to go 50 to 100,000 over asking was nuts. So even though we still are in a major seller's market, there are more opportunities for buyers, which is very key. And, it's crucial to work with a wonderful lender that knows those options and can present them to you so you can make an informed decision. Okay, number two. Was that all your points on that? Sorry, I forgot to check.
Yeah, that was everything I had covered.
Okay, cool. All right, number two. How about buying down the interest rate with points?
Yeah, so this is an option that you can take advantage of if the sellers aren't willing to pay costs. So
Okay.
in this instance, if the sellers aren't willing to pay costs, you can actually buy your interest rate down from your own funds. So this is something that I always like to have a conversation with my clients in detail about, to make sure
Hmm.
that this is something that's going to make sense. The
Right.
biggest thing that a buyer wants to do when determining whether or not buying down the rate is going to make sense for them, as opposed
Hmm.
to the alternative and not buying their rate down, is
Hmm.
determining when the savings that they're going to get by buying down their interest rate are going to outweigh the additional costs that it's going to cost them to buy the interest rate down.
Hmm.
So basically, what it takes for a buyer to buy their interest rate down is for them to buy what are called discount points.
Hmm.
So basically, what that is one discount point is equivalent to 1% of the loan amount in additional closing costs. So, for example, if somebody has a loan amount of $500,000, then one discount point is going to be equivalent to $5,000 in additional closing costs. And
Okay.
typically, one discount point is going to result in somebody's interest rate being improving by about 0.625%.
Okay.
So when we're discussing this with clients, we're always talking about, okay, you're saving, let's say hypothetically, $200 per month,
Hmm.
and you're, let's say hypothetically, paying an additional $2,000 in order to get that lower rate. So
Right.
we're always determining, you know, how long is it going to take for those $200 to
Hmm.
outweigh that $2,000? And a typical rule of thumb is, if you can recoup your costs in less than 2 years, then it makes
Hmm.
financial sense to buy the rate down.
Right.
But with interest rates decreasing here in the near future, and a lot of opportunities will probably present themselves for them to refinance, that's another
Hmm.
factor that we're taking into account. So
Absolutely.
in today's market, I would say if you can recoup your costs in less than 1 year, it's going to make financial sense. If not, you're probably not going to want to buy the rate
Yeah, that's important information. That's good to know. And I see, sometimes I get clients calling they've seen an advertisement from a big lender or something, and it's too good to be true. And I always tell them, read that fine print. Because if
Absolutely.
it seems like it's too good to be true, it usually is.
Absolutely. And I think it's always worth having a detailed conversation with the lender as well. If a
Yeah.
lender is pitching you a product and not really getting into the weeds of it, it's typically too good to be true. So
Yeah.
it's always something where you want to have a detailed conversation about.
Absolutely. It's in the details. We know that.
Exactly.
Awesome. Well, that's so helpful. So number 3, we've got, can a buyer qualify for a different loan product? That's a good question.
Yeah, that this comes back to as well, just having a detailed conversation about their current finances, their future goals on what they want to do with their finances, and then going over different loan programs and the pros and cons of each program towards their specific finances. There's probably about 50 different programs that we offer, and each have little differences in them that may cater to one person but not the other.
Mhm.
So I think it's really important just to have that conversation, put a couple of different programs in front of the buyer, and then make sure that we're putting them in the best program possible.
Right. And just so important for them to know there are options, especially right now. So, can you expand a little bit on the difference between conventional versus FHA?
Yeah, that's a great question. So the biggest determinant in which of these two programs is going to make the most financial sense for you is it's typically based off of what your credit score is.
Hmm.
So, for example, on an FHA loan, the amount that you pay in PMI every single month is going to be fixed no matter what your credit score is. So if you
Okay.
have a 620 credit score, your PMI is going to be the exact same as if you had a 740 credit score. Whereas on a conventional loan, the amount that you pay in PMI every month is based off of your credit score.
I didn't know that. See, I'm
Yeah.
learning stuff.
So on a conventional loan, if you have a 740 credit score, then your PMI is going to be a lot cheaper than what it
Okay.
would be on an FHA loan. But as you start to go typically below 690 to 680, you get to a point where the PMI on an FHA loan starts to be cheaper than on a conventional loan.
Okay.
So it's really based off of what your credit score is. Like you said, if you're above 690 to 700, you're typically going to want to go conventional. If it's
Okay.
below that mark, FHA is typically making the most sense.
Okay. Which, because it's tighter guidelines, it's a little more competitive in a multiple offer situation too, to have a conventional.
Yeah,
Okay.
everything's case by case. There's a lot of different
Right.
factors, but typically from an affordability standpoint,
Right.
those credit scores are what's going to make the most sense.
Awesome. Awesome. Yeah, I'm always on that first conversation. I always will kind of check in with people to see if they pulled their credit lately, to check, because sometimes I find people have stuff they are not aware of that's not even their stuff,
Right.
and it's not that it can't be cleaned up, it can take time to clean it up. So it's a good rule of thumb. I always say 5 to 6 months before you're ready to purchase a home, pull your credit report and kind of make sure there's no errors that need to be corrected. So
Yeah, I think that's
awesome.
really smart. It gives you time to plan if there is something maybe you didn't know about, or maybe an error on your credit report that could
Right.
affect, either the rate that you get or the PMI. So by giving yourself anywhere between 6 to 8 months in advance to take a look at those things and game plan, it's just going
Mhm.
to set you up so that you're paying as little interest and as little PMI as possible over the life of the loan, just because those do add up over time.
And it's amazing. Little tweaks can make a difference, more than I would have
Absolutely.
thought, is what I've learned in my experience.
Yeah.
So it's worth taking that time to do it for sure. Cool. Okay, number 4, we've got, consider an adjustable rate mortgage with a low intro rate. What can you tell us about that?
Yeah, so ARMs, adjustable rate mortgage, is what an ARM stands for, have become very popular in the higher rate environment that we're currently in right now. Basically, the different options for ARMs that we offer are a 5-year, a 7-year,
Mhm.
and a 10-year ARM. for that the first 5 years. On the 7-year, it's fixed for the first 7, and then the 10-year fixed for the first 10 years. And then after that, it's subject to change based off of whatever the market rate is. And there are what are called caps on these arms. So basically what that means is there's 2 different caps. So there's a annual cap, and then there's a lifetime cap. So basically what those say is on the annual cap, the interest rate can only increase or decrease by 1% every year after it's subject to adjust. And then the lifetime cap basically says that the interest rate can only increase or decrease by 5% over the life of the loan.
Okay.
So basically what that prevents is, if the market goes crazy and interest rates go up to 30%, which is obviously a doomsday. There's a lot more wrong with the economy than just the interest rates at that point.
Right.
But if that does happen, it saves you from your payment skyrocketing and gives you time to make any changes. But basically, the benefit of the ARM is that for those first 5, 7, and 10 years, the interest rate is typically about 1/4 to 1/2% better than what the market rate is.
Okay.
So it gives you a much more affordable payment for the first couple of years of the loan. So these are things that I would suggest for somebody who absolutely knows that they're poised to refinance when interest rates go down, and somebody, or potentially somebody who knows that they're planning to move for sure within the next 3 to 5 years. And they know for a fact they won't even be in the property when that interest rate adjusts. So these are absolutely some things that are some options that make a lot of sense right now, as long as you're planning around them and it makes sense.
Right. That's good information. Do you find that is there a prepayment penalty at all if you have an adjustable rate mortgage? Say you won the lottery and you want to pay a mortgage off.
No, so there aren't any prepayment penalties on first mortgages anymore, as long as they're backed by the FHA or Fannie Mae and Freddie Mac. Their prepayment penalties aren't legal on first mortgages anymore, so you don't have that to worry about.
That's good. I didn't know that. See, I'm showing my old age.
You just got to make sure that they're backed by the government in some capacity, and then there's no prepayment penalty. So if it's like a brokered product, there may be a prepayment penalty.
Good to know. Good to know. That takes us to number 5. This one, some people might not like to hear, but it's made the difference between buying a home and not. So I felt like it was a worthy one to include. But choosing a different property, you need to be flexible and think investment. So what can you tell us about that?
Yeah, I would say that's huge. The first thing that I want to hit on that point is that property taxes can vary from city to city and from house to house pretty drastically. So you could see one property at $500,000 that's going to have property taxes of, let's say hypothetically, $250 per month. And then you could see a house 5 streets down the road at $500,000, and that same price point has property taxes of $500 per month. So that's a $250 difference. I'm always encouraging my buyers to reach out to me prior to putting in any offers, and I can put together estimates for them. That way they can see what that monthly payment is going to look like prior to going into contract on a house. I just think it's really important because it can vary pretty drastically based off of the property tax. Number 2 is look into buying a starter home or a fixer-upper. Those are the properties that you can really get a good deal on. And if you do have the skills or are handy to fix something up, this is a great option to add a ton of equity in your house and to get a property at a price point that's lower than what the market tends to have. Another option is actually renting out a bedroom or a unit in a house that you plan to buy to a friend, a family member, or just anybody. I've seen instances where people have a $2,500 mortgage payment. they rent one of the units out for $2,000. And at that point, they're only paying $500 per month. So that can be a great option to really save money up front when purchasing a house.
Well, and that's nice too, because, you know, with our higher prices and as much as they've gone up over the last 3 years, you know, some people got priced out of the market. So I always recommend, you know, to still get in, not just a fixer upper, but open your range and go farther out, you know, and you might only live there for a year or two, you know, and maybe rent it, but it gives you options. And then, you know, if things have improved and appreciation has gone up, or who knows if we have another pandemic and prices go up another double again, you know, you never know. But
Right.
it's just thinking outside the box and looking at your different options for sure.
Agreed, especially for a first-time home buyer. I do a practice every single year where I reach out to past clients and just update them on their equity position in the house. And this past year, when I did it, over 95% of my past buyers had equity of over $100,000.
Wow.
And
yeah.
75% of those buyers put the minimum down payment down. So either 3.5% to 5% of the purchase price. And within years, they've already appreciated by over $100,000. So I think that the biggest step or the biggest goal just needs to get into a house that, you know, fits your goals. And then down the road, that appreciation, assuming nothing crazy happens, but historically, that appreciation is really what propels people into the house of their dreams.
Right. Yeah, it's so true. And I mean, historically, our interest rates are what, 7.75%, you know, which is, it's even hard for me to say, you know, I've even forgotten. But when I talk to some new first-time home buyers, you know, that they got used to that lower interest rate of 2.5%, 3.5%, and they don't realize it used to be that high, you know, so or higher. I mean, I remember back in the 80s when it was over 10%. It's just like, it's hard to believe. Now our prices weren't as high, you know, and I'm always asked, you know, are the prices going to come down? I feel we're going to level, and we are leveling some. But as long as you have a low inventory and high demand, it's going to keep those prices steady, you know, and I anticipate that through the summer here. So,
yeah, I mean, I would say every market is going to have a ceiling. You know, you see out the West Coast, the Seattles, the LAs, they've reached their ceilings, but that's also in the $1 million ranges. In the Atlanta market, you know, we're typically seeing on average, what, $400,000 to $600,000. So there's still a lot of room for that to grow before it gets to a point where people say, I've had enough, I can't afford any higher.
Absolutely. Okay. All right. And last, but certainly not least, we have number 6, consider putting a larger down payment. And we just had tax time, so perhaps a tax refund can be used. But what can you talk about on that front?
Yeah. So the larger down payment that you put down is going to affect your mortgage payment in a couple different ways. So just by putting more down, your loan amount's naturally going to be lower. So that's going to result in a lower payment itself. Another thing to keep in mind is that if you put over 20% down, you don't have to pay PMI. So that in itself is going to decrease the monthly payment as well. And then regarding the amount, if you don't have 20% to put down, the amount of PMI that you pay every month is based off of the amount that you put down and then your credit score. So for example, every 5% that you put down, you're going to be put in a better PMI rate. So for example, if you put the minimum of 5% down, you're going to be in a higher rate of PMI. If you put 10% down, that rate's going to improve. 15% down, it's going to improve even further. And then once you put 20% down, you don't have to pay it at all. So I always suggest, you know, reaching out to me. We can go over different scenarios, whether you're putting 5, 15% down, and we can kind of make a decision on which one is going to suit your profile best.
Right. But it's just, there's options there. So that's the key takeaway for sure. So, Awesome, Andrew. Well done. You shared a lot of valuable information today on how to get the best mortgage rate, and I really appreciate it. And I'm sure that people watching appreciate it too. And keep in mind, if you have any questions, we're here for you guys. So our contact info is in the description down below, and you're welcome to reach out. Just have the conversation. If I find that a lot of people have questions, 6 months or 8 months before they're ready to buy. So we're here for you. We want to have that conversation. We want to help guide you on your path to home ownership and your different options with your lending needs, because it's really important and it's so crucial to know that you do have options. Okay. So thanks for watching, you guys. Thanks, Andrew. You did a great job.
I appreciate it. Thank you.
All right. Looking forward to, we plan on doing these again, y'all. So stay tuned. Yep. And we'll be hitting the live stream here too. So thanks a bunch for watching, and we'll see you again soon.
Thank you.